Hello, and welcome to this second video from Theta Profits. Today we will dig into an options trading strategy called METF, meaning multiple entries trend following. We will talk to an experienced retail trader who runs this strategy very mechanically and with great success. But first, a quick disclaimer. This is not financial advice. All information in this video is for informational and educational purposes only. Options trading can involve substantial risk. Do your research and trade at your own risk. Today's guest is Dan Yaklin from Dallas in Texas. Welcome, Dan.
Oh, welcome. Glad to be here. Thanks for
How
inviting
are
me.
you doing?
I'm doing great.
Tell me a little bit about your background as options trader. How long have you been doing? What kind of strategies you have been doing?
Well, I started in options trading about 17 years ago. I wanted to learn more about options, so I took a course from a company called Optionetics, and I don't think they're even around anymore. And I, have dabbled in it for a little bit, when I first took the course and never really found a really profitable strategy. So I just kind of put it on the back burner, and been trading. I was trading stocks and ETFs in and out, for the past I don't know 14, 15 years, and then about in 2020, I discovered the zero DTE strategies on SPX, and so I've been trading those exclusively for the last 4 years. So that's kind of how I got started in it.
Wow, that's a pretty long trading career. I'm very happy to have you as the guest in this video, and we are going to talk about the strategy we called METF, and that stands for multiple entries trend following. Could you just very briefly explain what is this strategy?
So multiple entry just means that you're taking trades throughout the day at specific times, and the trend following aspect, and you're selling credit spreads, either a put credit spread or a call credit spread on the day of expiration of SPX. And depending on what the trend is doing at the time of your entry, and we'll define how you determine whether it's trending up or trending down. If it's trending up, you sell a put credit spread. If it's trending down, you sell a call credit spread. And that's basically it in a nutshell.
Very good. And let's just get to the point that so many people are always curious about, what are the results so far? You have a couple of slides here showing
Yeah,
that.
so the results you're going to see on the following slide represent trading one contract. The initial account allocation was using 50% buying power in the account with 50% in cash. And there was no interest on the cash that was included in the results that you're looking at, or that you will see. And the resulting equity curve was normalized to a starting value of $50,000. So in actuality, the count was less than 50, but I just normalized it so that you could see what would happen if you had a $50,000 starting account. And the performance slide was generated in early July. So in the slide you're going to see, there are not results for July and August and early September. So the returns for July were 3.9% in this in METF. The returns for August were 5.4%, and the return through September 20th for September was minus 2.1%.
So let's look at the performance slide here. These are impressive results so far. What do we see here?
Okay, let's look at the bottom right graph first. The blue line you see there is the actual METF performance graph. That's the equity curve for the METF strategy, with the percent return shown on the left scale. and the black line is SPX. If you were, buy and hold on SPX, so you can see the comparison between the METF strategy and just buy and holding SPX. And the red dotted line is drawdown, and it's plotted on the right hand scale, and it is plotted from the top down. So if you're not in any drawdown, you're at the top. If you're in drawdown, it drops down to whatever percentage that you see on the right hand scale. So you can see that the peak drawdown looks like it occurred early on in the year. And then above that you see monthly returns. So you can see the return of this strategy for each month. And in the top right, you can see the ending value, starting value and ending value. If you had started with 50,000, you'd have ended up with 75,570. And then you got the compounded rate of return, the max drawdown, and then CalMAR. If you're not familiar with CalMAR, it's just you divide the compounded rate of return divided by the max drawdown, and it's sort of a risk reward kind of factor. How much reward are you getting for the risk you're taking? And then there's some other statistics over on the left-hand side that you could look through. We don't need to go into it in detail, I don't think.
But these are quite impressive results, I would say, and very steady results. So I think we are very curious about the more to get into the more details of how this strategy is being traded. When you enter or when you exit, your rules. And so on. So I'll give you a few minutes to explain this in detail and bring up your slide with some of the rules.
Okay. All right. So METF just means, as we said, multiple entry trend following. So my rule set, this is the way I'm trading it. Now there's an infinite number of ways you could trade this, but this is what I do. I enter trades, and this is Eastern Standard Time. I enter trades at 12:30, 1 o'clock, 1:30, 2 o'clock, 2:30, and 2:45. And at the above times, I look at the 20-period exponential moving average of SPX, and I look at the 40-period exponential moving average of SPX and see which one is above the other. So if the 20 moving average is above the 40, then I assume we're in an uptrend. And if the 20 moving average is less than the 40 moving average, I assume we're in a downtrend. And that's on 1 minute. The EMAs are on 1 minute charts. So if the 20 is above the 40, then I assume we're in an uptrend, and I would sell a put credit spread. If the 20 is below the 40, then I would sell a call credit spread. And I would do that at each one of those times shown above. And I use 25, 30, or 35 wide on each credit spread. And since I'm using automation, it decides which width to use. It tries to balance the credit you get on each trade. So it picks 20, 30, or 35. And the strike, it selects strikes to obtain a credit in the range of $1.25 to $2.50, and it tries to get as close to $2.50 as it can without going over, but it won't take a trade for less than $1.25. And then once you enter the trade, you immediately set a stop on the credit received, and so you're going to have a 1x stop, which means if you collected $2.50, you would put your stop at $5, which means if you lose on that trade, since you've already collected a $2.50 credit and you lost, if you got out at $5, it would have be a $2.50 loss. So either you're going to make whatever you collected in credit, or you're going to lose that amount. So it's like a 1-for-1. Whatever you collect in credit, you'll either make that or lose that amount. I hold till expiration. I don't close early. I don't take profits early. I just hold it, and either I make my credit or I lose that amount, one or the other. And The other thing is I do not trade on Federal Open Market Committee days when they're making their rate announcements, because the market goes crazy, right after they make their announcement, and you tend to lose on those days because the market's wild and crazy. And I don't trade on FOMC minutes days, which always follow the market interest rate announcement day by 3 weeks. So if they have a FOMC meeting and they make their announcement on a Wednesday, then 3 weeks later on that Wednesday they release the minutes, and that can also tend to gyrate the market around and cause you to have losses. So I just don't trade on those days. But every other day I trade. Every other day I enter at those times. I'm strictly mechanical, and that's it in a nutshell about how my rules work.
But I'm curious about a couple of things. One is, why have you picked these opening times? That you had 6 times that you are opening the trades mechanically. Why these times? None in the morning, for instance.
Yeah, so that's a good question, and I try not. I ran back tests when I started doing this, and you can get in the weeds in back tests and try to pick, the exact best time and the exact worst time to enter, and I wanted to not trade early in the morning. I wanted to trade later in the day after the market has sort of settled down. So I just picked those times and ran tests on it, and they worked okay. And so I just stuck with it. I don't want to over optimize. That's one of the things that I try not to do, is over optimize. And I try not to, look. I could run back tests and say, oh, last month this time worked best, so this month I'm going to trade that time. But I think that's chasing fool's goals. I just don't believe that, you can predict which is going to be the best time in the future to trade. So I just pick those times. And the second reason I like trading later in the day is that your risk is for a shorter period of time. Where if you're starting to trade early in the morning, then you've got that risk on all day long. Where if you trade, starting at 11:30 or 12:30 Eastern, then your risk is over a shorter period of time.
But why have you chosen to be so mechanical? Because you're very mechanical, while a lot of other traders would choose to be more discretionary, try to read the technical analysis and how the candles are moving, etc., and catch the best movement. But you are just strictly mechanical in what you do. Why have you chosen to be so mechanical?
Well, there's 2 reasons. I'm trading multiple accounts, and I really could, if I was going to try to trade those with using discretion, it would be very difficult to trade that many, trade the several accounts that I'm trading and being discretionary on them. Because I'm trading a business account and then several retirement accounts. And the other reason is, I'm open to discretionary trading if it's proven to be, if it proves that it works better than the mechanical. And we've done some looking at, there's several people that I'm familiar with that we've looked at their results, and they're discretionary traders. And when we put our results side by side, I don't see the benefit. I just haven't seen that there's, a significant advantage to go to all that effort when you can just be mechanical and get similar results.
And you said that you are using an automated system, so your trades are being placed by a bot or by a software. Can you elaborate a little bit on that?
Yeah, so the software that I use is a Trade Automation Toolbox. It's available. You can Google it, and it works very well. I've been using it since they first came on the market 2 years ago, and I've had really good results with it. And I actually manually trade a couple of accounts. And when I first started using it, I was manually trading just to compare and see how the automated results compared to the manual trading, and they were roughly equivalent. So I'm, I'm happy with the results that I've been getting with the automated trading. So if it works, stick with it, I guess.
Okay, very good. And I have a question for you, because if some strategies are more risky than others, so to speak, with a bit more volatility and bigger drawdowns, etc. So if I ask you to put this strategy based on your experience on a scale where 1 is very low risk and 10 is very high risk, where would you put this strategy in your assessment?
That's a good question, and it's hard to answer. Probably in the middle somewhere, around 5 or so. But the issue with this strategy is if you had a black swan event, it would be very high risk. I mean, you could lose a lot of money. Now, what's the probability of a black swan event? That's the question you have to ask yourself. And one of the things that I like about trading from 12:30 to 4 o'clock, those entries, if a black swan event occurred, it would have to occur in one of those in that time frame for it to impact you. And in fact, for it to impact you at the maximum, it would probably have to occur between 2:45 and 4 o'clock in the afternoon when you got all your trades on. If it occurred after you had one trade on, then it's not going to be as big of an impact on you. If a black swan event occurred and you took a max loss. So,
And I guess now you also answered my next question, at least partly, because that is, what is the worst that can happen with this strategy?
okay, so the worst that can
Biggest risk.
happen, the worst that can happen is you can have all your trades on, after 2:45 Eastern Standard Time in the afternoon, and you have all of your puts. You haven't stopped out of any of your puts, and you had a black swan event. You would lose the entire spread width. So if you had a 25 wide spread for a single contract, you'd lose $2,500. And for that reason, I don't risk my entire account. I don't risk any more than 50% of my account. So if I had a black swan event, I would still have half my account left. I could still keep trading. And in fact, the results you saw in the previous slides show, only allocating 50% of your account to the strategy and keeping 50% in cash.
To what extent do you experience slippage issues when you are stopped out? And are you setting the stops on the spreads, I understand, or on the shorts only?
So the automations, I set it on the spreads, and but you have to be careful when you're sitting on a spread. Later in the afternoon, when your long becomes worthless, you don't want it on a spread anymore. You need to convert it over to having a stop only on the short, because it won't execute if there's no bid on the long. And so the automation takes care of that. When the bid becomes worthless on the long, it'll automatically convert it to a stop on the short. Did that answer your question?
Yes, it did. I know that you also trade another strategy called MEIC, multiple entries iron condor, and we're not going to go into depth in that today. But I found it interesting how you look at these two strategies together. So let's just very briefly explain what is the MEIC strategy.
So the MEIC, it's a multiple entry iron condor, and it's a delta neutral strategy. So you're not trying to pick a direction where the market's going. You just are hoping the market stays in a tight range, and then you collect the credit on both the put credit spread and the call credit spread at the end of the day. And I enter them at the same times as I enter the METF. And what I found is that if I do both together, I get a smoother equity curve with less drawdown than if I'm trading each one individually. And so for that reason, I trade right now. I've started trading in the last few months. I've started trading a 50% allocation to MEIC and a 50% allocation to METF.
And I find this very interesting. My let's say bread and butter strategy is something I call zero DT break-even iron condor, which is similar to a large extent to MEIC, and I've been just testing a bit in very small on XSP, something similar to your METF, and it's very interesting to see how they kind of smooth each other out a little bit, and I'm very happy about what I see so far. So I might scale up eventually after seeing it over a longer period.
Yeah, that's what I did. I ran the METF for a year, just trading one contract, and took a look at the results, and then looked at my results for MEIC, and in a spreadsheet, just blended the two together and looked at the results and found that it definitely improved the overall equity curve. And so that's when I started to scale up and put 50% in MEIC and 50% in METF.
For people who are curious about this strategy, do you have a tip about where to learn more about it?
There are a lot of videos, I think, on YouTube that you can go look at that talk about MEIC. I think Tammy Chambliss is a well-known trader that has put some videos out on MEIC, and METF is very, very similar. I mean, once you understand MEIC, the iron condor, then it's just a small change to implement METF. So that's what I would recommend.
And Tammy Chambliss, who you mentioned, she lives in Dallas too, as far as I know.
Yes, she does.
She runs the Facebook group Quantum Options, where
Yes,
she
she
actually
does.
posts her result both on the MEIC and METF every day.
Yes.
For people to follow. So I think that is actually a good Facebook group to
And she
follow.
has a Discord group, Quantum Options, also, which is quite a lot of information there on both of those strategies.
Our time is running out, but I would like to, if you were to sum up about this strategy, and especially who is it a good match for? What type of trader is this a good match for, would you say?
Well, I mean, you can trade it discretionarily, just like you do. I mean, that's perfectly fine if that's your comfort level. If you want to trade it mechanically, like I do, that's my comfort level. I think it works for both. So I think anybody could, and even with automation, somebody that's working all day could trade it. So that's a plus. Where if you're a discretionary trader and you're trying to work, you'd have a hard time during the business day, especially if you're in the United States. Now, if you're in Europe, it's a different story. Maybe you can overlap some and trade it, and still work too. But so it would be good for somebody that's working, if you do use automation.
And I guess it's good for those of us who have no clue about where the market is going on any single day.
Yeah, that's right.
Sometimes I feel we are a minority, but it's good with a strategy that works for us as well.
Yes.
Well, Dan, thank you very much for joining in this video. I really appreciate it, and you sharing your knowledge and your experience.
Well, thank you for having me. I enjoyed being here.
Thank you very much.